Hey everyone, and welcome. Today we're going to dive into a really powerful strategy to make your investment portfolio way more resilient. We're talking about something that can help you weather the storms while you're still chasing that growth. Let's get right into it.
So, this is the big question we're tackling today. What if I told you there's a way to build a safety net that's so strong it lets your high-growth investments just run wild without you losing any sleep over it? Well, let's find out. Look, if you're an investor, you know this feeling. We absolutely love the incredible growth we can get from equities. But we're also kind of terrified of two things, right? Those sudden market crashes that can just wipe out our gains, and that slow, silent killer, inflation, just eating away at our money's value. It feels like a constant tightrope walk.
So how do we get off that tightrope? Well, that's where this idea comes in, the gold-debt hybrid. I want you to think of this as a financial shock absorber that you build right into your portfolio. Its job is to smooth out all those bumps in the road. So what is this thing really? Simply put, a gold-debt hybrid is a dedicated defensive layer. It's a very deliberate mix of two different things. You've got gold, which is your classic crisis hedge, and then you have debt, which gives you that steady, predictable income. The whole point of putting them together is to guard against market swings and inflation. Okay, but how do these two completely different assets actually work together to create stability? Let's break it down and look at the two pillars to see how they perfectly complement each other. And this lays it out perfectly. On one side, you've got gold. Think of it as your shield. When things get chaotic in the economy, or inflation is high, or the market's taking a nosedive, gold tends to shine. Then, on the other side, you've got debt. This is your steady foundation. It's the part that just provides those predictable, stable interest payments, year after year. You know, a perfect real-world example of this whole idea in action is the sovereign gold bond, or SGB. It's a pretty unique instrument. You get all the potential upside from the price of gold, plus the government pays you a 2.5% interest every single year. And here's the best part. When it matures, any capital gains are completely tax-free. It's literally the best of both worlds in one neat package. And of course, SGBs aren't the only game in town. The debt part of your hybrid can be built with things you're probably already familiar with, like fixed deposits or a public provident fund. The main thing is to find those stable, predictable returns. Okay, so the theory sounds good, right? But does it actually hold up in the real world? Let's get to the data, because that's where you can see how this strategy really performs when the pressure is on. This is where it gets interesting. And this is the headline number right here. A mix of gold and debt delivering a 9% compounded annual return over 2 decades. Now, when it says it hedges 6% inflation fully, what does that actually mean for you? It means your money isn't just growing by 9% on paper. It means its real-world purchasing power, what you can actually buy with it, is growing by about 3% every single year. Now, that is a real safety net. Let's just focus on that number for a second. 9%. And remember, we're talking about your defensive layer here. It's not just sitting there doing nothing. It's actively compounding and protecting your wealth from inflation. And if you want to see this in action more recently, just look at 2022. It was a pretty rocky year for the markets. You can see here that a major stock index, the Nifty, dropped a painful 12%. But look at gold. It was actually up 5%. That's your crisis hedge working perfectly, cushioning the blow from all those falling stocks.
So, what would this actually look like in a real portfolio? Well, here's a quick example. You might have 70% in equities. That's your growth engine. But it's being supported by that 30% defensive layer, 20% in steady debt, and 10% in gold as that ultimate safety net. That 30% is the shock absorber we were talking about. It's what lets the other 70% do its thing.
All right, let's bring this all back to you, because the real question is whether a setup like this actually makes sense for your goals and your comfort level with risk. So let's just think through a few key questions. First off, ask yourself this, and be honest. If the market were to tank tomorrow, do you have at least a 10% buffer in your portfolio? Something like gold that has a really good chance of holding its ground or maybe even going up?
Next, think about the long game. How would having a chunk of your portfolio just chugging along, compounding at a steady 9%, act like a shield over the long run, protecting all those hard-earned gains you've made in your more volatile stocks?
And finally, the big one, inflation. I mean, we're all feeling it at the grocery store, right? If inflation suddenly spikes way higher than anyone expects, is your portfolio ready for it? Do you have that reliable hedge built right in to protect your buying power? So, if those questions got the gears turning, here's your call to action. Don't just take my word for it. First, go find some online calculators and simulate a few different gold and debt blends. Second, just do a quick search for the dates of the next SGB auctions. And third, and this is the fun part, test it. See how your simulated hybrid would have performed in the past against a portfolio that's 100% in stocks. The results might surprise you.
So what's the bottom line here? The gold debt hybrid isn't just about playing defense. It's a shock absorber that also compounds, giving your entire portfolio the stability it needs to grow over the long haul. And maybe, just maybe, that's the real secret to letting your equities truly run wild.